Welcome back, Focus Learners. Today, we're taking a really deep look at a piece of financial wisdom that is, well, pretty universally accepted, but actually rarely completely understood. Everybody tells you to diversify your investments, right? It's treated as this ultimate golden rule of personal finance, the ultimate safety net. But what if I told you that the very strategy you're using to protect your money might actually be the exact thing quietly dragging down your potential? We are talking about the diversification trap. This is exactly what happens when safe investing quietly makes you poorer. We're going to look at the data, the structures, and exactly where that line is between smart protection and total portfolio chaos. Okay, let's dive into this. To really understand this trap, we first have to acknowledge that golden rule. Don't put all your eggs in one basket. We all know the logic here, and honestly, it's beautifully simple. Think of a clean, simple basket of eggs. If you have all of your life savings wrapped up in a single company stock, and that company suddenly goes bankrupt, well, your basket drops. The eggs shatter. Your entire financial future basically crashes right along with it. Diversification was explicitly designed to make sure that one single dropped basket literally cannot destroy everything you've worked so hard to build. And this brilliantly illustrates how a perfectly balanced approach, spreading your risk across completely different sectors like airlines, tech, healthcare, and energy, is just a thing of beauty. Imagine a perfectly balanced pie. If some massive global event happens and, say, travel grinds to an absolute halt, well, that specific slice takes a hit. But because your money is also sitting safely in tech, healthcare, and energy, your overall portfolio remains totally structurally sound. Actually, those other sectors might even be having a record year. So one bad sector barely makes a dent in your overall financial health. It is, for sure, one of the most proven ways to reduce your risk without sacrificing your returns. But here is the record scratch moment. What happens when you take a genuinely good idea, like diversification, and you push it entirely too far? What if having 50 or 100 baskets is actually a massive mistake? I know, it sounds totally counterintuitive. If some protection is good, shouldn't endless protection make you invincible? Unfortunately, that is just not how the market works, and it's definitely not how portfolios work. Past a certain point, diversification actually stops protecting you. That clean safety net, it turns into a cluttered, tangled web, and it starts quietly working against your financial goals. Welcome to the dark side of the golden rule. We call it over-diversification. This happens when you add portfolio complexity and overlapping funds without actually adding any real financial protection. It usually happens when a highly responsible investor goes out and buys, say, 15 different mutual funds or ETFs, assuming they're building this impenetrable fortress around their money. Visually, if you map it out, their portfolio looks incredibly cluttered. It feels like they've covered literally every possible angle. But that sense of ultimate security, yeah, it's largely an illusion. Let me show you what's actually happening under the hood here. You might think those 15 different funds mean you own thousands of completely unique investments. But in reality, you are very likely just holding the exact same 200 mega companies over and over again. Because so many mutual funds and ETFs are market cap weighted, they tend to heavily feature the exact same giant tech, energy, and retail titans right at the very top of their lists. So you aren't actually buying a diverse set of new companies. You are just paying 15 different fund managers a fee so they can all log on and buy the exact same giant tech stocks on your behalf. It's a really messy trap, just bundling the exact same giants up in confusing packages. Now, what's really interesting about this overlap is that it boils down to this. Same stocks, different labels, zero extra protection. Just imagine a chaotic web of overlapping Venn diagrams. Fund A holds the biggest smartphone maker. Fund B, which calls itself a growth fund, well, it holds it too. Fund C, a tech fund, also holds it. If that smartphone company has a genuinely bad quarter, all three of your supposedly diversified funds drop at the exact same time. You see, you haven't diversified your risk at all. You've just duplicated it. You've added a literal mountain of paperwork and complexity to your life without actually shielding yourself from a market downturn. And here is where over-diversification actively hurts you. It fundamentally waters down your success. Let's say you hold a clean, well-researched portfolio of just 20 stocks. If just one of those companies absolutely explodes in value and, say, doubles its stock price, that single winner has a massive, highly visible impact on your overall wealth. You are going to feel that victory. Now look at the other side. If you hold 300 different stocks through this tangled web of funds, and one of those companies doubles in value, the impact is completely diluted. It's a drop in the ocean. It barely moves the needle. By trying to own everything, you are actively silencing your absolute best-performing investments. This is what we call the cost of the chaos, and honestly, it comes with a real financial sting. First, as we just saw, you have diluted gains from your top performers. Second, you are effectively diversifying your way into totally average returns. Think about it. If you own a tiny piece of every single company in the market, the good ones and the bad ones, your returns will just mirror the market average, but with way more effort. And the third point here, this is the real kicker. You are paying multiple overlapping management fees for this privilege. You're paying Fund A, Fund B, and Fund C entirely separate fees just to have them all buy the exact same stocks. You are paying a premium price for totally watered-down performance. Let's move on and see how this builds, because we've looked at the clean simplicity of a basic basket, and we've waded through the cluttered, expensive chaos of over-diversification. So where exactly is the line? At what point do you stop adding protection and start adding pure, unadulterated baggage? Well, fortunately, financial researchers have been studying this exact question for decades, and the math actually gives us a surprisingly clear answer. So the crucial point is this. Historically, research reveals a very clean, sweet spot of 20 to 30 individual stocks. As long as they're spread across completely different, non-correlated sectors, holding 20 to 30 companies captures the vast majority of the true mathematical benefit of diversification. Once you move past 30 individual stocks, the amount of risk reduction you get for every new stock you add basically falls off a cliff. Adding a 31st stock, or a 50th, or a 100th adds almost zero structural safety to your portfolio. It just brings us right back to that trap of overlapping complexity and diluted gains. So how do we actually find that balance in our own lives? Well, it's time to clean house with 3 simple steps. First, identify your overlapping mutual funds. Look under the hood and see if your different funds are really all just buying the exact same top 10 companies. Second, trim the redundant labels. You absolutely don't need 5 different funds doing the exact same job. And third, recognize the power of a single broad index fund. If you buy one low-cost index fund that tracks the whole market, you are instantly holding hundreds of companies. That gives you incredible built-in diversification in one single, perfectly clean move. The mistake isn't holding a diversified fund. The mistake is stacking 10 of them right on top of each other. There's a concept that perfectly summarizes everything we've talked about today. Diversification is a shield. Over-diversification is that same shield so heavy you can barely lift it anymore. You want your portfolio to protect you from the unexpected arrows of the market? Absolutely. But if your shield weighs 500 pounds because it's bogged down by 15 overlapping mutual funds, redundant fees, and diluted returns, you can't move. You lose your agility and you anchor your own growth straight to the ground. The goal of investing was never to own absolutely everything. It was to own just enough to be safe and nothing more. Which brings me to you, our focused learners. I want to leave you with this provocative question. How many individual stocks or mutual funds are you currently holding in your retirement and brokerage accounts? Seriously, I challenge you to pull up your portfolio this week, look past the fund names, and check for that hidden overlap. Are you truly diversified, or are you just overloaded with a heavy shield? Do an audit and then drop your number down in the comments below. Let's see who has a clean portfolio and who has a little bit of decluttering to do. If this explainer changed the way you view your investments, make sure you subscribe so you never miss our next breakdown. Until then, keep learning, stay focused, and keep those portfolios clean.